So, how can small apartment investors analyze asset class characteristics? Well, let's break it down step by step and see what really matters here. First, it's important to review historical performance data. You want to compare average returns, standard deviation, which is basically volatility, and Sharpe ratios for different asset classes. Also, make sure to examine how each asset class performed during various market conditions like recessions or bull markets. For example, equities may show strong returns in bull markets, while bonds tend to perform better in downturns. Next, you'll want to analyze correlations. This means studying how different asset classes behave relative to each other. You can use correlation coefficients to identify which asset classes complement one another. For instance, during periods of inflation, commodities like gold usually do well, while bonds may underperform. Finally, it's time to construct a balanced portfolio. The goal here is to combine asset classes in a way that optimizes risk-adjusted returns. For example, you might allocate 40% to real estate for steady cash flow and appreciation potential, 30% to equities for growth, 20% to fixed income to stabilize your portfolio, 5% to commodities to protect against inflation and currency fluctuations, and 5% to cash equivalents to ensure liquidity and preserve capital. So, let's talk about how to incorporate market conditions into your investment strategy. You'll want to adjust your allocations based on the current economic outlook and trends in asset class performance. For example, you might increase your holdings in commodities during inflationary periods and shift more toward equities when the economy is in a growth phase. So, let's take a look at a historical risk and return comparison, just as an example. If we look at some hypothetical averages, equities have had an annual return of about 10%, but with high volatility. Their correlation with real estate is around 0.3, which is considered a low positive correlation. Now, bonds have shown an annual return of 5%, with low volatility, and a negative correlation with equities at -0.2. Real estate, on the other hand, has averaged a 7% annual return with moderate volatility, and a low positive correlation with bonds at 0.1. Lastly, commodities have had an annual return of 6%, also with high volatility and basically no correlation with equities, sitting at 0.0. Diversification really offers some important benefits. A portfolio that combines these asset classes can achieve reduced volatility, thanks to the low or even negative correlations between bonds, real estate, and equities. Plus, you get improved risk-adjusted returns since diversification typically leads to a higher Sharpe ratio. So, what does this mean for small apartment investors? Well, balanced growth is a big one. Real estate provides stable returns, while equities and alternatives can drive growth. There's also inflation protection, since real estate and commodities help hedge against rising costs. Risk mitigation comes into play too, with fixed income and cash equivalents providing some stability during periods of market volatility. And finally, smoother returns are possible because the low correlation between these assets helps reduce overall portfolio risk. To sum it up, understanding asset class characteristics and their risk-return profiles is really crucial for building diversified portfolios that optimize performance and keep risk in check. By analyzing historical performance data and correlations, small apartment investors can put together resilient portfolios that balance growth, income, and stability. And by knowing how different asset classes behave in various market conditions, investors can better align their portfolios with their goals and adapt to changing economic landscapes.